Today we're going to build the ultimate dividend stock portfolio. If I was going to build the ultimate portfolio made up of only the very best companies that had the potential to grow and paid me a dividend every single month, how would I do it? Okay, so first up, some rules to make sure we get the best possible portfolio. First, we need to make sure we get value as well as yield. A company that's going to go down in value over the next years or that has major red flags is not going to give us solid returns. Second, I want to stick as much as possible to UK-based companies. The UK may be struggling for growth, but it does do dividends very well, and it also avoids us paying dividend withholding tax. In the US, this is typically 30% on dividends. The UK does have an agreement which reduces this to 15% once you complete a W8BEN form.
That's quite a mouthful.
But a 50% tax is still a huge blow to dividends before we receive them, so let's avoid that. Thirdly, I want to make sure we're getting a diverse range of companies from different industries to spread our risk. And lastly, I'm going to be using the Dividend Aristocrats list to ensure we get the best quality companies. If you're unfamiliar with the term Dividend Aristocrats, it's essentially a list of the 40 companies with the highest dividend yields, and those who have a dividend policy of increasing or who have had stable dividends for at least 10 consecutive years. This ensures we get the most reliable dividends possible. So to kick things off, I'm starting with a spreadsheet I've grabbed from moneyinvestingexpert.com, so a huge thanks to them. Now, this data looks a bit overwhelming at first, so the first thing I need to do is take away some columns that we don't need. ISIN number is just used to identify the stocks, so let's get rid of that one. Trade country and currency, we know they're all in the UK, so they can go. To tidy it up a bit further, what we can do here is sort by market cap. This is essentially a measure of the size of the company. The largest on the list is AstraZeneca, but the smallest on the list is even moneysupermarket.com. So by no means are any of these small companies. So I'm going to hide that column too. Now with these remaining stats, I'm less interested in some than others. These first three, price, dividend amount and yield, i.e. the percent you're paid as a dividend. These are going to change, in particular the price and yield. The price of the stock obviously goes up and down each day, except for weekends and national holidays. And the yield is calculated by dividing the annual dividends per share by the share price, which is changing daily. And now, because we're able to buy fractional shares, i.e. £10 of a stock, rather than needing to be able to have 9,408 pence or £94 to be able to buy a share in AstraZeneca, the price doesn't quite matter, nor does the dividend amount in pounds. I'm just interested in the yield. The next column, price to earnings ratio, relates the company's share price to its earnings per share. Typically, the lower the better, as it means it's good value. The problem with this depends on the industry and what's good for that specific sector. I'll keep that for now, as it may come in handy later when we compare similar companies in the same industry. Earnings per share is calculated as a company's profit divided by the outstanding shares. The result gives us an indicator of how profitable the company is. So typically here, the higher the number, the better. The dividend payout ratio is the amount of dividends paid to shareholders in relation to the total amount of income the company generates. This will obviously depend on what the company is doing with their money, how much is invested versus how much is paid as a dividend. Next up is the grueling bit for me. I need to work out which months each of these companies pay their dividends in. And bam, that was a lot faster for you than me. Okay, so now we've got the payout dates, let's start with January. Now there's a couple of companies that really stand out to me here. First, we've got GlaxoSmithKline, the UK-based healthcare provider with a 5.25% dividend yield. And secondly, we've got British American Tobacco in the tobacco industry with a 7.1% yield. The third stock that piques my interest here is Tate & Lyle, who specialise in the food and beverage industry. Each of these three pay a good portion of their profits to dividends and have a nice dividend percent. GSK and British American Tobacco have higher earnings per share, and a tool I like to scan them by is the compare feature on Simply Wall Street. When I do that, I can quickly see that these two are 60% undervalued, whereas Tate & Lyle is just 9%. And a red flag is a dividend is not currently well covered by its earnings. So for January, that gives me GSK and BAT, covering the healthcare and consumer industry, but I'll call it tobacco, with an average dividend yield of 3%, but remember those numbers are subject to change. Now you might be thinking that doesn't work out, the average of 5.2 and 7.1 isn't 3, but remember these are paid quarterly, so we'll actually get this percent paid out 4 times per year. So we have to divide it by 4. We'll actually get paid out by these stocks in January, April, July, August, October and November, so those first two picks have given us some nice coverage throughout the year. Now let's do the same for February. Again, there's 3 here that pique my interest. United Utilities, a utility company, Sage Group, who own the popular accounting software, and Primary Health Properties because they all pay a strong dividend. When we compare these, it does throw up a few things like their dividend not being well covered, but remember the benefit of the Dividend Aristocrat list is all of these companies have paid for the past 10 years. There's no guarantee this means they'll continue to pay, but a strong indicator that dividends is a top priority for them. The reason I'm actually going to include all of these is diversification. Two of these are actually the only utility company and tech companies that make the list for reliability. In a similar fashion, Primary Health Properties is one of the few property stocks. Now I will add a caveat here, that a lot of property stocks did cut their dividend, rightly so, through the pandemic. So a few others may be worth considering here like Taylor Wimpey. But for the purpose of this, we're going to stick to the consistent dividend payers. So let's add those three, giving us an average dividend yield for February of 4.4%. And of course, let's add the other months that those companies pay out. Now in March, there's one company that stands out, one of the best dividend payers in the UK, and that is Unilever. They own a huge selection of brands that we buy in the supermarket every week. A strong dividend paid 4 times per year, they are a must. The other one I would add here is IG. They're a huge online trading broker and they pay a really nice chunky dividend of over 5%. That also gives us some diversification into the finance sector. That brings us to an average dividend in March of 3.92%. Once we add in the other months, our calendar is actually starting to fill out quite nicely. What's interesting here that in just 3 months, we've already got a dividend payment in each month of the year with just 7 companies, and we're actually already across 7 different industries, which is a great start to diversification. The good thing about this is it now allows us to pick and choose for the rest of the months. So in April, we've already got GSK and BAT, so let's eliminate those from our list. There's one stock that's a must for me, and that is Rio Tinto, my favourite UK miner. I think this stock is a must-have in any dividend portfolio. It's always paid a good chunky dividend, over 50% of its earnings go towards the dividend payments, and it has a huge earnings per share. Diageo are also a stock I really like for the next year as a defensive play, but they are very similar to Unilever, who we've just added, who are currently paying a higher dividend, so I'll pass on them for now. So let's add Rio Tinto, who pay out in April and September, and that brings my April average to 9.16%, which is the highest by far. Moving on to May, and this is where things start to get a bit more difficult. We already have Primary Health Properties, there's a couple of obvious picks here, Legal & General and Admiral, and there's not a huge amount between them. LGen has a higher dividend, but Admiral has higher earnings per share. For the sake of diversification, I'll add them both to the portfolio. The other one here is Schroders, which is an investment manager. They have a strong earnings per share as well as a strong dividend. They slightly overlap with the other companies, but I ideally want a range of companies within each sector. So if one has an issue, it will balance out. So I'm going to add all 3 to the portfolio. The side conversation here could be Money Supermarket, but they do have quite a low payout ratio, so I'll skip them for now. So let's add those companies, and that gives us an average dividend yield for May of 9.67%. For June, we've already got a couple of good payers here, Unilever and Sage. Smith & Nephew I did contemplate here as they make medical devices, but their payout ratio does put me off, coupled with the fact their dividend isn't well covered by their earnings. Intertech Group I also considered. They provide high quality assurance services. A lot of their work is in the US, which I imagine with the current exchange rate isn't helping, and the dividend is a tad low for me. The one I will be adding here though is BAE Systems, who are an aerospace company, which adds some more diversification to the portfolio in the industrial sector. A respectable dividend and over a 50% payout ratio is nice to see, and they pay out in June and November, which gives us an average yield for June of 4.4%. Moving on to July, we've currently only got GSK, which isn't a lot. I'm not a huge fan of adding companies just for the sake of it. These 3 are pretty low, dividends under 2%, and Asura reported poor earnings, and they have over 1 billion in debt. With growing interest rates, I don't think it's worth adding. So for July, I'm going to stick with GSK, an average dividend yield for the month of 1.3%. Not huge, but other months more than make up for it. August is a similar situation. We've already got BAT, Primary Health Properties, and United Utilities. We've already considered others in January and May, so I'll pass on those. With our 3 in August, that brings us out to an average yield of 4.94%. September is already looking pretty full up. We've got 4 companies so far, and to be honest, the majority of companies left for September have quite low dividends. Ideally, I want at least a 3 or 4% dividend to provide me with a higher level of return. Phoenix Group make less than $1 million in revenue, which is off-putting. I think at this stage I will add Money Supermarket for a couple of reasons. It's rated as being 32% undervalued, earnings are forecast to grow by 12% per year, and analysts expect the price to grow 24%. Plus, they've been steadily increasing their dividend. I'm slightly concerned by the payout ratio, but they have paid out dividends for over 10 years consistently. So let's add them into September and May, which brings our average average for September to a whopping 14.97%, which is huge. It also gives a nice little boost to our May totals, bringing it to 12.62%. October, I'm happy with the ones we've got. I've covered Assura, I've covered Smith & Nephew. You could possibly add Diageo in there, but I mentioned Unilever are a better pick in my opinion. So let's keep it as it is with IG, Admiral and GSK, giving us an average yield of 5.96%. November, I'm also going to stick. There's two other options, but both have a dividend yield of 1%, which I'd consider to be low. So which means in November, we've got British American Tobacco, BAE Systems and Primary Health Properties, which gives us an average yield of 4.6%. December, we don't have a huge amount of choice. Ashmore Group are there, but they do have a huge one-off loss of 54 million, which is enough to stop me buying them for the time being. Maybe one to consider in the future if they overcome it. So that just leaves us with Unilever in December with an average yield of 1.07%. Now, obviously some months are drastically better than others because of the way the payout schedule works. April, May and September are brilliant months in terms of payouts. But overall, you want the average for the entire year, which is 5.86%. Remember though, this will change every day, so this is just a rough indication. Although these fluctuate, these are still companies I would use for my dividend portfolio. You could consider adding some others, but these are the most reliable by far. You could use these as a base and always add more to them after, or possibly even add a dividend ETF which has a collection of companies in it. That way, if one cuts its dividend, it doesn't matter too much. One last point to make is about diversifying what I've got here. I've got 9 different sectors here, but you'll notice I've got 4 in the financial sector and I've got 2 in tech, so this is what I would do. Let's say we've got £10,000 to invest. I've got 9 different sectors, so let's do £10,000 divided by 9, £1,111. So for example, with healthcare, it's simple. I'd invest £1,111 into GlaxoSmithKline, as there's only one company. Then for financial, because I've got 4, I would split that number by 4. So £277.50, and I'd put it equally into IG, Legal & General, Admiral and Schroders. That way I've split an equal amount into each sector. So I'm spreading my risk more equally. Of course you don't have to do that, but that's just what I would do. And that completes my ultimate dividend stock portfolio, and here it is in its full glory. I hope this was helpful and gives you some ideas of what you can add to your portfolios. And let me know your favourite dividend stocks, if you'd swap or change any of these, and which ones you think should be added. If you missed my latest portfolio update, you can check it out right here, or if you've seen that one, you might also like this one, and I will see you guys over there.